wanted to take a look at the stock market today, which if you looked at the past couple days, we're seeing the stock market rally significantly. There's hope that there's going to be some kind of resolution or some kind of deal. Now, I want to break down the entire economy. I have a list of economic indicators, some of which you really want to key in on going into this month coming. Now, a lot of the economic indicators we've just seen are for all through April. We've seen economic indicators for March. Then we got, of course, Liberation Day and excessively punitive tariffs. It isn't necessarily so much the tariffs that you should be really focusing on, or at least what I'm focusing on, as much as some of the economic indicators that are likely to show what will happen next with the overall broader economy. Specifically, our economy is consumer driven, and the consumers are seizing up faster than they did over COVID. That should explain some things to you. Now, keep in mind, relative speaking, COVID, we were all getting, not all of us, Americans were getting stimulus checks. We're not getting stimulus checks. Instead, we're getting tax increases across the board on the items that we consume more frequently. What will happen to the U.S. economy? Let's take a look at the economic indicators right now going through, which the economy itself is fairly robust, still holding in there from March's data. April, of course, is when all things have shifted. We will see these economic indicators throughout the month of May showing up for what happened in April. And that's key. I want to break down what's going to happen in the stock market today, such as SPY ETF, and then, of course, bond markets, what will happen with TLT ETF. Personally, I am still going heavy into TBT ETF, which would be the inverse to that. Let's jump in. If you are finding me on my Substack channel and this is in your feed, make certain to hit the subscribe button. Thanks so much for following along. My numbers, I'm in the top, I think 50 right now, fastest growing in the finance. If you're finding me on my YouTube channel, you'll want to stop by dhtayloranalysis.com or dhtaylor.substack. Links are down below. You'll be able to get my free email newsletter, which this email will include videos that I am putting out, and also access to direct chats, which I have the chat thread. There is a pull down menu for the chat there. All right, let's take a look at everything. Here's a look at it. SPY ETF, the S&P 500 Trust. And as you can see way over there, now this goes back, I think it's January 2024. So about a year and 5 months, 4 months, we're pushing the S&P 500 back upward. I do not see a potential for us to clear the hurdles of the previous all-time highs. Now, I think a lot of what we're seeing is the potential that China will not see as punitive tariffs across the board. They're one country. There are only 4 countries that were not tariffed. Belarus, Russia, Venezuela, and somebody else, Cuba, who knows. They all seem to share a common thread. Regardless, what I could see happening, the pause, and I think it's going to be roughly July 10th, July 5th to the 10th, 7th to the 10th, we will see that pause, and Trump will either initiate those across the board higher tariffs or he will maintain the 10%. My thinking is he maintains 10%. Now, here's someone who believes that absolutely nothing he does has any consequence whatsoever. The markets have proved him quite differently, that there are consequences to all of these actions. Because of that, we've seen the stock market sell off significantly, 22% in weeks, days after, hours after he announced his tariffs and things of that nature. But the bond market seizing up was such a huge shift that he didn't see coming. There are consequences to actions. We are dealing with an economy that is consistently steady as you go, steady as you go, steady as you go. That just got bulldozed. So there would be consequences to this. Now, the Republican Party wants to raise this revenue simply to be able to pay off the tax cuts they want to do while simultaneously pushing the budget higher. This is, if you've looked at my previous video that I just had, and I've got a link to it that I'm going to put up there for you, this will push the deficit higher. Now, the tariffs themselves, even if we hit 10%, you're looking at the de minimis itself. 4 million packages a day that are going to be hit with roughly a $200 fee attached to it. This amounts to about $20 billion in tax take for the federal government per month. So that's some money that they're seriously looking forward to. But again, they felt as if there would be no consequences to any action whatsoever. We're seeing ships not showing up. Now the ports, I've been continuously looking at the ports. Are there ships there? Because you keep seeing these social media accounts where they're sitting there saying, hey, the ports are empty. Yeah, they're taking video shots of ports that haven't been used in 3 or 4 decades. Regardless, we are seeing a decline, and I divert to the Port Authority CEO in Los Angeles, the largest port authority, where he's giving us data points saying we're going to see 35 to 40% less shipping containers starting to arrive in less than 10 days. Now, there is a process of, tariffs hit, okay, stop buying stuff, and ships come over. That ends, or the lack of ships begin, in about 10 more days. This week and the week after, we should see the results of the ships not showing up. That's not going to play out too well in the news. It's certainly already not playing too well in consumers. They are seizing up, and that's one of the key things. So the fact that SPY ETF is moving up as much as it is, I look at that and I'm thinking, wow, what... Thanks for giving me a springboard to get ready to dive off of with as this dies down. We may very well see SPY ETF continue a bit higher. Trump may backpedal as he's been doing. He's come out with these massive statements and then immediately has to backpedal because he realizes that he's creating 1929 all over again. Because of that, I think we hit 10% across the board and it's just left there. Fine. Actually, the economy might do well, not well. Wouldn't be catastrophic. We'll start from that as our foundation. We could see the stock market absolutely soar because of the news that it's not going to be nearly as terrible as you thought. And that's pretty much what we're seeing right now. But from there, it will be a continued erosion, and I've got all the economic indicators that I want to point out. The U.S. 10-year Treasury yield. Again, my previous video, and I'll have links to it, where I break down this symbiotic relationship. First, the United States federal government lives well beyond its means. Second, we have a deficit with our trade partners, specifically Japan and China and all other countries. Very few countries do we have a surplus with. Singapore, which they got a tariff, makes no sense. Those countries, when they get their dollars because of this trade deficit, they only repatriate a small portion, maybe 50%. But they're not repatriating everything. And because of that, what they're not doing is selling their dollars for their currency. That instead, they're buying our debt. So you got the federal government who's pushing the deficit further and further. The debt keeps growing. And these countries are already sitting on, countries, banks, private investors, institutions, sitting on these excess dollars. What do you do with it? Let's buy some treasuries. 22.5% of our debt is owned by other nations, institutions, investors, central banks. Trump may have very well resolved the trade deficit, but he didn't resolve the budget deficit. if we see a steep drop off in shipping containers and packages coming in from, say, Shein, HG, whatever it might be, that revenue that they're counting on simply won't show up. And these punitive tariffs are so high that you're going to see the buttons not being pressed at a huge drop off. So all the money they're counting on raising simply is not going to show up. Simultaneously, these institutions that are holding dollars don't hold dollars. 22.5% of our customer base, if there was a one-for-one relationship there, no longer exists. So great, you solved the trade deficit, but you now have to deal with the budget deficit, which that's not exactly going to work out. Because of that, my expectation is we will see a very slow frog in the boiling water scenario where interest rates gradually, in a sustained manner, continue to move higher and higher and higher. So for now, the 10-year Treasury yield's kind of popping up a little bit higher. I could see 4.5, 4.75 over the course of, say, prior to the end of summer. It will be slow, methodical. The lack of customer base. China is diversifying. China will no longer have excessive dollars in a quantity that's meaningful to step in and buy that Treasury debt. Think about that for a moment and play that through in your mind. The TLT ETF, a lot of you guys have been following me because of TLT ETF. I don't think everything's changed. And whereas previously I had been buying TLT ETF for a long-term move over 100, 110, 115, 120, maybe even 125, those were my dreams a while back. Everything's changed. Now I'm looking at TLT ETF and thinking, you see that low at 77? That might go. All right. How exactly is the U.S. economy? Let's look at some economic indicators and some of the things that I'm kind of looking at. And here's the money supply. For anybody who has followed me for any period of time, you know that I'm always looking at a rate of change, year-over-year growth rates. And this is the money supply. Now, we just saw a huge influx of money showing up into the United States because of there was a surge of buying imports, and all of a sudden you had all these Chinese exporters and other exporters sitting on dollars and pushing into United States treasuries. We've seen the data points. We've seen the surges in the purchasing of treasuries. That stops as of last month and into this month, April into May, and throughout June, July, August, I expect TIC data. You can look that one up. It's one of those things that I'm going to be putting a lot of content out to show how much foreign interest there is in U.S. treasuries. This one is going to be such a key indicator to keep an eye on. For now, that money has showed up. Now I expect M2 money supply to continue to contract. From that, economic expansion will continue to move negative. Now we're just slightly above zero right now. Below median, but slightly above zero. And I think a lot of what we've just seen is because of the huge influx with foreigners sitting on US dollars and putting them to work in the United States of America. And that propelled the economy forward, but that's gone. Personal incomes, more and more people get hired, more and more people earn aggregate income. If you're in a job and you step up a little bit and you get a higher pay raise of some kind, you will see an increasing amount of income. From that, we see an increasing amount of consumption. And as you can see, we've moderated. Not quite close to zero. We're sort of in between the median there, just above zero and the median. Consumption is following suit. Now, however, we're looking at confidence, which is plummeting, and there's a direct correlation between confidence and consumption. So if simultaneously we will see individuals simply not working nearly as much. The truckers are going to be the first. We've seen UPS sitting there saying, 20,000 jobs gone. There's going to be ripple effects throughout the economy as these companies secure their bottom lines. unemployment will increase, which means personal income will decline on a year-over-year basis. From that, consumption follows suit. This becomes a negative feedback mechanism. Good news that we got in April, of course, PCE did moderate slightly. How does the Fed handle this? On the one hand, they're going to see big price jumps, plain and simple. On the other hand, they will see big jumps in unemployment. My thinking is, regardless of any saber rattling we may hear and any complaining, the Federal Reserve at least stays pat for some period of time until they can get a solid assessment as to what price increases they're dealing with before they make any kind of moves. Then they could systematically increase interest rates. That is not off the table, and I think a lot of people think it's a done deal that the Federal Reserve eventually is going to lower interest rates. In the face of higher price pressures, I'm not so sure. Non-farm payrolls, now we did get April's number, and most of the data points I'm talking about are from March. Non-farm payroll is still steady, but this was from April, and that's surprising that the economy, despite having the tariffs show up in April, we're seeing a pretty big pop. So this is something that we could probably see moving forward. The thing with employment that is so crucial is it's a lagging indicator. Businesses have already kind of made some moves and made some investments, and because of that, done some hiring, and we're seeing the results of that. It will take 2, 3, 4 months with employment before we really start to see businesses making shifts, because they may simply just be waiting to see before they make significant decisions, employment being one of them. This is one of the most important indicators that I'm looking at right now. University of Michigan consumer sentiment versus personal expenditures. Now, I showed you personal incomes, the blue chart, year-over-year gains was declining. Expenditures right now are kind of topping out on a year-over-year basis, but what just happened? Personal expenditures just popped up significantly higher over the past couple months as they front-run tariffs. I don't have actual data on that, but this is where some of the evidence points to this. So now that we're seeing significant price increases, we may see significant declines in personal expenditures, the rate of growth year over year change. So I don't expect this to hold. But the real key thing is University of Michigan consumer sentiment. Consumption and sentiment are hand in hand. They've divested from each other significantly over the past couple years since COVID, and sentiment itself simply hasn't gotten there. One of the reasons is price increases. Okay, we're getting tariffs, which will be price increases. Michigan sentiment tied for second all-time low. I believe this month coming, we break that low. Plain and simple. Expenditures will follow suit. We're seeing tariffs across the board, and I believe that these excessively punitive tariffs, specifically against Canada, maybe China, Mexico and Canada, China, Mexico and Canada, I believe we drop down to a mere 10%, because the aftermath of these tariffs in the market have shaken the administration to its core somewhat, to the point where they had to pause. They often step backpedal. And I believe that we're going to see a systematic backpedaling of the punitive levels and merely get 10%. And the economy itself would still grind lower and lower, slower. But we'd probably weather 10% across the board. And because of that, we would probably contribute to the deficit, if you will. So we'll see how that plays out. But I fully expect within the next couple of weeks that some kind of announcement or some kind of deal with China is made, and then from there, we're only going to do 10%. The stock market would soar on that news. But then the economy would slowly grind slower on that news. De minimis, this one is such an important one. 4 million packages a day coming through CBP, Customs Border Patrol, at anywhere from $100 to $200. You're looking at about, even if they get 15 billion monthly, you're looking at some pretty sizable, it's about 175 billion in tax revenue brought in for the federal government, that's about the increase that the Republicans are trying to push through for just defense. Now they're trying to slash other things, but if they could pull off that 175, that would go a long way to resolving some deficits. For now, I will be paying attention heavily to TIC data. Now, TIC data, Treasury International Capital Flows. You can Google that. It's one of those things that I've known about for 20 years. We'll chime in and look at it from time to time. Oh, what's going on there? Steady as we go. Steady as we go. Nothing's changing. All of a sudden, things are changing rapidly. So it's one of those economic indicators you never really pay attention to until you need to start paying attention to it. I will be looking at this every single time we get a data update. I get Treasury emails from their auctions. Prices, everything seems to be holding the line for now, but I expect significant shifts all through May, June, July, and August. The US dollar itself, I expect to continually deteriorate simply because of some of the factors going on. This is one thing that I've put out a lot of content on that. Since there's one of the things that China is doing, China's not getting US dollars, but what they're doing is some of their holdings that they do have, they're diversifying out very quietly, very systematically, with a view to long term. They've been around for 5,000 years. Their attitude is quite different than the United States of America. Our attitude is, what's the next quarter? Their attitude is, what's the next 5,000 years? It's a bit different. They're diversifying out into gold. They're diversifying out into other currencies throughout the world. They want to build their own sort of financial system outside of SWIFT and anything related to the US dollar. They're playing the long game. The United States of America isn't coming close. Overall, I expect an overall economic contraction. Plain and simple. I do not believe that we can sustain the economic growth that we've seen. All the charts slightly pointing downward at this point. Consumption, confidence being the key indicator that will likely pull consumption much lower, and that becomes a snowflake at the top of a mountain gathering momentum. Bond yields gradually, systematically, continuously moving up slightly. On average, just a couple more basis points per month. Frog in a boiling water scenario. We are missing out on dollars flooding in to buy those treasuries. TIC data will prove that this is likely what's happening and why interest rates continue to move higher. I do not believe the Republican Party can pull it off the way they want to. They will create a bigger deficit like they normally do. And because of that, with the lack of funds coming in to buy our treasury debt, price is going to have to move lower, which means interest rates goes up. Equities themselves, I don't understand why the stock market is rushing as high as it is. I expect an announcement out of Trump and the administration saying we're not going to be nearly as bad as we initially stated. We got a great deal. It's amazing, the best deal ever. And so we're only going to go with 10% across the board. And because of that, equity market will likely shoot further higher. But then it's a matter of, okay, well, what is the exact damage done to the economy? Here's one I've been playing a little bit. SQQQQ is one of those ETFs that is an inverse to QQQ. And in this case, I am looking for some bottoming, then I'm buying calls, lottery ticket style. And I'm going to wait for the market to kind of settle down a little bit. TBT ETF, this is the inverse, effectively the inverse to TLT ETF. They're not, one's ProShares, the other one's someone else. I can expect TBT ETF, which is 2x, negative 2x actually, to bond prices, which means if yield moves up, theoretically 1% or 1 basis point, you would get 2 basis point move higher in TBT ETF. There are others out there that are 1 for 1, 2 for 1, and 3 for 1. I've been playing TBT ETF a little bit more. I'm looking for sustained pops higher, then I'm out. And I'm just bringing in money. I was systematically buying TLT ETF to just hold it out long term. I'm not. I see TLT ETF moving significantly lower. Here's another one that I've been playing a little bit with. That medium term spike higher came a little too, didn't move up nearly as much as I had wanted to. Then all of a sudden we got the Liberation Day. I had expected to cross 19. It didn't quite get there. Close. Those options that I had on that evaporated. We could clear the 19 hurdles. So SVOL is actually simplified volatility. This is the inverse. And I like playing this one because this thing rockets really fast. But eventually I expect SVOL, after we probably clear this 19 level, I will more likely than not be buying puts because this thing could plummet. I don't expect a shock and awe type move. I expect low, slow moves downward with a lot of what's going on, the equity market specifically, and because of that SVOL ETF moving downward sporadically based on economic indicators hitting the market showing, wow, things are not really that great. Overall, the economy itself has performed quite well up until Liberation Day. Now I've broken down basically this symbiotic relationship between other countries, money flowing in to the United States via the trade deficit paying for the budget deficit, which the budget deficit very likely could move higher, whereas the trade deficit is moving lower, and that spells a lot of issues economically. Make certain to check that out. Substack viewers, if you're finding this, thanks so much for subscribing. YouTube, make certain to pop over, grab my Substack newsletter. You get these without the commercials. We'll see you in the next video.